all participants? I hope you are all able to hear me and can see me also. If you have any audio problem or video problem, please contact now. Before we start the session today, if you are facing any audio or video problem, please point out. So, we are discussing in our last session revenue recognition, so we will look at two case studies or two examples of revenue recognition. The first one is on your screen. Please go through it. So, Limited has a contract to provide a bundle of business advisory services to B Limited for a fixed fee of 1,80,000 over the term of 18 months, starting 1st January 2010. So 30 June 2011, the contract expires. A Limited is not able to identify individual services delivered to B Limited through the period. So individual services which have been provided to B Limited at different points of time during the period could not be determined. However, based on the past experience, A Limited can make reasonable estimates of the cost that will be incurred to fulfill its contractual obligations and also its stage of completion. Till its stage of completion. So, A Limited estimates that it will cost 1,44,000 to complete its obligation under this contract. So, progressive cost schedule is given below. You have to determine the revenue to be recognized for the 2 years using US GAAP and IFRS principles. So we'll see the difference over in US GAAP and IFRS principle regarding how revenue should be recognized over this 2-year period. So 1st January 2000, the contract starts, and up to 31st March 2010, cost incurred is 7,200 and cumulative cost incurred by A Limited for fulfilling its obligation under the contract is 7,200, which is 5%. So cumulative percentage completion up to 31st March 2010 is 5%. 30th June 2010, cumulative cost incurred is 28,800 during this period, April to June. So cumulative cost incurred is 36,000, which is 25%, is the cumulative percentage completion in terms of cost. On September 30, 2010, that means the quarter during July to September, cost incurred is 50,400 and cumulative cost incurred is 86,400, which is 60% of the total cost of 1,44,000. The cumulative percentage completion is 60%. December 31st, 2010, the cost incurred during that quarter, October to December 2010, is 36,000. Cumulative cost incurred up to December 31st, 2010 is 1,22,400, which is 85% of total cost incurred to be incurred 1,44,000. So 85% is the cumulative percentage completion in terms of cost till December 31st, 2010. March 31st, 2011, that is for the quarter, January to March 2011, cost incurred is 14,400. cumulative cost incurred is 136,800, which represents 95% of total cost. So cumulative percentage completion is 95%. And June 30, 2011, the cost incurred during that quarter, the last quarter, April to June 2011 is 7,200. Cumulative cost incurred is 1,44,000, and 100% is the cumulative percentage completion. So this is the progressive cost schedule. So how revenue will be recognized during these 2 years? Under US GAAP, the service revenue has to be recognized on a straight line basis unless a clear evidence suggests revenue earned or obligation is fulfilled in a different pattern. So unless there is a clear evidence that which suggests revenue or obligation is fulfilled in different pattern, service revenue has to be recognized on a straight line basis. So US GAAP prohibits using cost-to-cost revenue recognition method. Hence, revenue for the year 2010 will be on straight line basis. If we do it, there are over 18 months of service has to be provided. 12 months have expired from 1st January 2010. As on December 31st, 2010, 12 months have been completed out of the 18 months of contract. So 2010 revenue will be 1,80,000 total revenue under the contract into total revenue into 12 by 18. So it comes to 1,20,000. And 2011 revenue will be the remaining 60,000, which is total revenue for the 6 months period. So 1,80,000 into 6 by 18. So under US GAAP, the revenue recognition for 2010 will be 1,20,000 and revenue recognition for 2011 will be 60,000 under this contract. But under IFRS recognizes revenue based on the stage of completion or percentage of the completion method. So the stage of completion is clearly evident on cost-to-cost basis. Hence 2011 revenue is 1,80,000 into 15% because 2010 revenue will be 1,80,000 into 85%. Because if you will see from the last slide, up to December 31st, 2010, 85% of the cost has already been incurred. So on cost-to-cost method, stage of completion is completion, cumulative percentage completion up to December 31st, 2010 is 85% and the remaining 15% is getting completed in 2011. So under IFRS method, 2010 revenue will be 1,80,000 into 85%, which is 1,53,000, and 2011 revenue will be the remaining 27,000, which is 15% of 1,80,000. So you can see clearly under these two methods or under these two accounting standards, when an entity uses US GAAP as the accounting standard, it will be determining revenue on straight line basis, whereas under IFRS it will be determining revenue on percentage of completion basis. So the entity, if it is in US, if A Limited is a US entity, determination of revenue will be different from if it were a entity in UK or some other country which follows, some other country in the world which follows IFRS. In this example, showing you the difference between accounting standards and how difference between the accounting standards can lead to different recognition of revenue under the same contract. We'll go to the next example. So you can read it out first. In your screen it is available. It will be available right now. Now it is available on your screen. So please go through this exercise. On 1st of April 2013, Z entered into an agreement to sell 100 computers to a customer for $1,200 each. The normal selling price of one computer is $1,000 and the cost of the manufacture is $900. The contract includes a service agreement under which Z will carry out all repairs on the computers for the next 4 years. Z has estimated that the average annual cost of repairs for a computer will be $45. So how the transaction should be accounted in Z's financial statement for the year ended 30th September, that means after 6 months. Now the contract has basically two elements. One is the sale of computer, the other is the service contract. You have to understand the contract is for selling of goods and also for providing services. So it has sale of computers and servicing of computers too. So it's a contract basically bundles sales with service. So it's a sale of goods plus rendering of services. Okay. So on 1st of April 2013, when Z sells these 100 computers to the customer for $1,200 each, for each computer they receive $1,200 from the customer. So on this receipt there are $1,200, there are again two components, $1,000 for sale of goods and $200 for service to be rendered in future. So how it will be accounted for on 1st of April 2013 in Z's books? So one revenue will be $1,000, cost of goods sold is $900 and profit is $100 for each computer. So for the first part of the revenue, that is for sale of computers, the revenue will be recognized $1,000 for each computer sold. Cost of goods sold is $900, so profit is $100. The remaining $200 will be recognized as a deferred revenue. So $1,200 received in respect of each computer. The sale of goods component part of that is $1,000 will be recognized as a revenue. Cost receipt of $1,200 is $200 will be treated as a deferred revenue because it will be earned over a period of 4 years. It is going to be, it's for the service to be provided over 4 years, so it will be treated as a deferred revenue. The deferred revenue account will be created with $200. Sales will be created with sale of goods or sale of computers account will be created with $1,000. Okay. Now on 30th September, when 6 months are expired from 1st April 2013, on 30th September 2013, on straight line basis, we have to calculate how much revenue has been earned from the services. Out of the deferred revenue of 100, how much can be recognized as revenue for the services rendered. So this is basically 48 months contract, 4 years. 6 months have been completed. So 6 by 48 into 200, that is a pro rata on straight line basis. 200 into 6 by 48 or $25, 1 week of 200 will be recognized as service revenue on a straight line basis. The remaining 175 will remain in the as deferred revenue in the books. And cost of services rendered is 45 is the annual cost of repairs. So 6 months cost of repairs will be 22.5. So cost of services rendered will be taken at 22.5. services rendered revenue will be $25. So this is how the accounting will be done in Z's book as on 30th September 2003. So the transaction should be accounted in Z's financial year. So in Z's financial statement, the remaining part of the service revenue, that is $175 per computer, will appear as a deferred revenue, as a liability, not as an income. Is that clear? Any question on that? If you have any question on this, understanding this particular exercise, you may raise it now. In this exercise or the earlier exercise, please raise it now, because now we'll be moving to another lesson. That is the lesson for today. This is the leftover of the lesson of the last session we conducted in the last session. So, yes, what's the question? I am waiting for that. Rituparna from Guwahati. Repeat which one? The second exercise? The computer thing? We have discussed two, so which one you want me to repeat? Okay, fine. See, this contract which is limited has entered, the agreement it has entered for selling 100 computers, it is basically comprising two things. One is sale of goods, that means sale of computers, and the other is providing service, rendering of service over a period of 4 years. The customer is paying $1,200 for this each computer, because he is not only buying the computer but paying for the service, repair services, which will be provided by the manufacturer over a period of 4 years. Normally the computer costs only $1,000, so why the customer has paid more or going to pay more, $1,200, because it is also availing a service that the computers will be, Z will carry out, the manufacturer will carry out all repairs on the computers for the next 4 years. That is the service part. So $1,200 that has been received on 1st of April 2013 by Z Limited from the customer, it has got two components. One component is the sale of the computer, which is $1,000. The remaining part, $200, is for services to be rendered in future. Future means after 1st of April 2013 for next 4 years. Is that clear? Rituparna? This point you have to understand, then the rest is easy. So $1,200 basically comprises two components. One is sale of goods component, that is sale of computer, that is $1,000, and the remaining $200 for services to be rendered over a period of 4 years starting from 1st of April 2013. So when this $1,200 is received in respect of each computer, how this will be accounted for in the books of Z? $1,000 will be accounted for revenue from sale of goods. So revenue they will account, this is from sale of goods, 1,000. The other component will be treated as a deferred revenue from services. So revenue from sale of computer, this is 1,000. And the other part is deferred revenue from services, because this revenue is a deferred revenue. The whiteboard is there. Can't you see the whiteboard? Are you not able to see the whiteboard? Anybody is not being able to see the whiteboard? So revenue from sale of computer is 1,000 and deferred revenue from services is 200. Because on 1st April 2013, from 1st April 2013, on that day, I am talking of 1st April, the day the contract entered, on 1st April 2013, this is the accounting entry. Revenue from sale of computer 1000 and deferred revenue 200. Now here the cost of goods sold is how much? Corresponding cost you have to, if you look at it, is 900. So profit is 100 at this point of time. Cost of a computer, cost of manufacture of a computer is 900. So profit is 100 from sale of computer. But this is still not earned. This is a deferred revenue on 1st April 2013. Now on 30th September 2013, out of 48 months, this is a 4-year contract, out of 48 months, 6 months have passed. So how much of the service revenue has been earned? On a straight line basis, on pro rata basis, $200 per computer, so 200 into 6 by 48. So 200 divided into 6 by 48, which is nothing but 200 by 8 or 25. This is the revenue, service revenue earned. So on this service revenue, so deferred revenue from services account will be debited and service revenue account will be paid with $25. So on 30th September 2013, when 6 months has passed, on straight line basis, of the 4 years, 48 months, 6 months have expired. So how much revenue of this 200 has been earned? This was the deferred revenue on 1st of April 2013. But on 30th September 2013, a part of this deferred revenue has been earned due to passage of time, that is 6 months. Because the contract is for 48 months. So 200 into 6 by 48 or 200 by 8, that is 25 is the revenue earned from services. This is the position as on 30th September 2013, and the remaining 175 is still a deferred revenue. That has not yet been earned. That is deferred revenue on 30th September 2013. And what is the cost of rendering this revenue for 6 months? Cost of rendering the services. So cost of services is, because it costs, how much it costs to provide the services for each computer. Annual cost of repairs for a computer is $45. So we are talking of a 6 months period. So cost of services is 22.5. The profit from services is 2.5 at this point of time for each computer. Is that clear? So question is on 30th September 2013, how much of the services revenue we should recognize? That is the important question. Because the services have to be rendered over a period of 48 months and only 6 months have expired from the date of entering into the contract. So 6 by 48 or 1/8 of the total service revenue should be recognized as the revenue earned from services. Is that clear or still not clear? Vichaparna. Okay, thank you very much for asking the question. It's good of you to ask the question. Anything not clear, you have a right to. What is the question from Abha Mahendra? I will be continuing till Mr. Mukherjee takes over. So he has not come back yet, as I know he is not available at this moment. So till the time he resumes or he comes back, I will be taking your classes. Cost of services is basically, it is given $45, please remember. Z has estimated, see the last line of the exercise in the first para. Z has estimated the average annual cost of repairs for a computer will be $45. So if the average annual cost of repairs is $45, so for 6 months how much is the cost? For 45? 22.5. Is that clear? I don't have your name. The participant from Bhubaneswar Satpanagar. Anyway, is that clear or not clear? That is how I got the cost of services. The information is given in the exercise. Okay, thank you very much. So revenue is the amount received. What we learned actually, revenue is the amount received or receivable from third parties in respect of goods or services rendered. Profit is 100, revenue is 1000. See, revenue is 1000, cost of goods sold, this is the cost of manufacture by computer is 900. So profit per computer is 100. Is that clear? Revenue is not equal to profit. I have never told the revenue is equal to profit. Revenue is 1000, that means from sale of computers, it is 1000 is the revenue. Cost of goods sold or cost of manufacture of each computer is 900, so profit is 100. Is that clear, Jyoti? Did I write revenue equal to 100? I wrote revenue equal to 1000 and profit equal to 100 from sale of computers. And from services the profit is, this is profit from services for 6 months period, profit is 2.5 per computer. Is that clear, Jyoti? Any confusion in mind? I hope no. Okay. So revenue is the amount, what we've learned is that revenue is the amount received or receivable from third parties in respect of goods supplied or services rendered. Which one? This doesn't mean anything. You are using the word this. Please tell which one. Be more specific. Deferred revenue is revenue which you have not yet earned. On 1st April 2013, have you provided the services? You will be providing the services over a period of 4 years. On 1st April 2013, only thing you have done is you have entered into the agreement. So can it be considered as a revenue at that point of time? Tell me. You have entered into an agreement to provide services over 4-year period for which you are charging customer $200. So will it be considered as a revenue already earned or revenue to be earned in future from services rendered? That's why it is called deferred revenue. Yes, Aman Shah. So 1,200 per computer, out of which computer has been supplied, so revenue has been earned in respect of sale of goods. But what about services? Services have to be provided over next 4 years. So you cannot consider 200 to have been earned on 1st of April 2013. It's a deferred revenue. Revenue is measured at the fair value of the consideration received or receivable. So if there is a market, if there is a transaction, then the price paid is the revenue. If there is no monetary transaction, then you have to basically arrive at the fair value of the consideration. Okay. Cost incurred in respect of a transaction can be identified and readily measured. That is one very important thing. You can recognize revenue only when cost incurred in respect of the transaction can be identified and reliably measured. So supposing in this particular case, why I am emphasizing third point is, in this particular case, you don't have any idea about how much it cost you to render the services. Here you have an idea, $45 is the average annual cost of repairs of the computer. If you have no idea, if the company has no idea about how much it costs to repair the computers, so the cost cannot be reliably measured, then you cannot recognize the service revenue, the $200 as a revenue, till the contract expires. Till that time it will be only a liability. That income will be treated as a liability. So cost incurred in respect of a transaction can be identified and reliably measured. That's a very important criteria. And under US GAAP, there is a large volume of guidance on revenue recognition, including numerous industry standards which are not available in IFRS. IFRS is not so detailed. It doesn't have so much of guidance which is available in US GAAP on revenue recognition for various industries. So these are the points we have learned, basics to summarize. So we'll move to the next lesson, which is relating to capital expenditure, property, plant and equipment, that is IAS 16. So we'll try to, in this session, we'll try to define and differentiate the capital expenditure, revenue expenditure and deferred revenue expenditure. Deferred revenue expenditure, I am not using the word expenditure. So capital expenditure, so we are coming to the other side, expenditure side. So we are going to talk about what is capital expenditure, how it is different from revenue expenditure, how it is different from deferred revenue expenditure. So we try to define and differentiate what are these three kinds of expenditure which we call CapEx, OpEx and DFE. CapEx stands for capital expenditure, OpEx stands for operating expenditure or revenue expenditure. That's why it is called OpEx. And third is the deferred revenue expenditure, which is called DFE. In short, we will learn how to identify and apply the definition, recognition, measurement and disclosure requirements for tangible fixed assets, property, plant and equipment. Tangible fixed assets generally means property, plant and equipment, etc. So tangible fixed assets are property, plant and equipment, how to identify and apply the definition, recognition, measurement and disclosure requirements in respect of this kind of assets. We will also learn to identify the complete life cycle of a fixed asset and accounting methodology, including unit depreciation and revaluation. So we will talk about two models, cost model and revaluation model. And secondly, lastly, we will differentiate between the provision of US GAAP and IFRS. So what we are basically going to talk about or discuss in this session and maybe the next session also is International Accounting Standard 16. So we'll talk about IAS 16 mainly. So IAS 16 applies for property, plant and equipment. It prescribes rules regarding the recognition, measurement and disclosures relating to property, plant and equipment, which are often referred to as fixed assets. PPE, short name is, so applies to PPE. We'll be using more of this word PPE. It means the full form of PPE is property, plant and equipment, which is otherwise called fixed assets. So IAS 16 is for property, plant and equipment. It prescribes rules regarding recognition, measurement and disclosures relating to property, plant and equipment, which is otherwise called fixed assets, which would enable users of the financial statements to understand the extent of entities' investment in such assets and the movements therein. So any user of the financial statement should be able to understand the extent of the entity's investment in such assets and the movements therein. The principal issues here relate to recognition of items of property, plant and equipment. This is what we are going to discuss. The principal issues involved relate to recognition of items of property, plant and equipment, to recognize an asset as a property, plant and equipment under that category, determining their cost, how to determine their cost, initial cost and subsequent cost, initial measurement and subsequent measurement, and assessing the depreciation and impairment losses which should be recognized. So these are the principal issues we will be discussing under IAS 16. There are several other accounting standards which will be coming up during our discussions apart from IAS 16. Okay, that we will see. Let's go to the next slide to see that. So the relevant IAS or IFRS, so relevant international accounting standards or international financial reporting standards for tangible or intangible non-current assets. These are the 6 which apply for various kinds of tangible and intangible non-current assets. So IAS 16 relates to property, plant and equipment. IAS 38 relates to intangible assets. So difference between PPE and intangible assets: PPE are physical, they are physical assets. Intangible assets have no physical existence. That is the main difference. Then IAS 23 deals with borrowing costs for acquisition of such assets, how they have to be treated, interest charges, etc., interest paid for on loans taken to buy fixed assets, etc. Then IAS 36 deals with the impairment of assets. IAS 20 relates to government grants, and IAS 40 investment property. So there are various IAS or accounting standards related to tangible or intangible non-current assets in the balance sheet. In this course, we will be only covering, in this GFAS course, we will be only covering IAS 16 in this session and maybe in the next session. 38 and 36, that is basically relating to intangible assets. I will come one by one. We'll discuss everything. IAS 38 and 36 relating to which basically deals with intangible assets and impairment of assets, that will be dealt with in subsequent sessions. And relevant coverage of IAS 23 and IAS 20 only. IAS 23 relates to borrowing costs and IAS 20 relates to government grants. So we'll come to that. When we talk about in a particular example, we talk about what is meaning of government grant or government subsidy, we talk about that. When we cover IAS 20 only, that much portion. But remember, IAS 20 will not be, or IAS 23 will not be discussing in detail. Only the relevant coverage of IAS 23 and 20 only, this will be discussing. The 2 kinds of fixed assets, there are basically, you can come across 2 kinds of fixed assets in a company's balance sheet, that is tangible, which is called property, plant and equipment, and another is intangible. They are used in production or supply of goods or services, and both these are subject to impairment as per IAS 38. So IAS 30 is there. For impairment of assets is a common standard for applying to both tangible and intangible fixed assets. Investment property, the last one which we will not be covering, that is IAS 40. Basically, investment property are those land or building held by the owner or by the lessee under a finance lease to earn rentals which is not in the course of business, so that the business is not in the business of letting out property and renting it out property, buying property and renting out property. That is not the business of the entity. So if the business of the entity is something different, then investment property means basically land or building held by the owner or the lessee under a finance lease, on rentals and or for capital appreciation rather than for use in the production or supply of goods and services or for administrative purposes or for sale in the ordinary course of business. So if the land and building are held for some other purpose other than basically to earn rentals and for capital appreciation rather than for use of the production or supply of goods and services or for administrative purposes or for sale in the ordinary course of business, so that where IAS 40 applies. So we will not be covering IAS 40 through GFAS course, it will not be covered. So we will be basically today covering IAS 16, maybe a part of it we will be covering tomorrow, then we will go to IAS 38 and also IAS 36 we will discuss. IAS 20 and 23 we will be discussing, we will just talk about them where it comes in the context. So somebody is asking meaning of grant. What is the meaning of grant? So government sometime to encourage, normally these are given by the government, so government sometime to encourage setting up on a particular type of industry, setting up of a industry in a backward area, provide grants to the industrialists, subsidy or grants to the industrialists. So, supposing the government wants solar energy to be produced in a big way. Now the priority is on renewable energy. So solar energy is a very big source. Solar energy or wind energy, these are very big, could be big sources of renewable energy. This kind of energy generation doesn't create environmental pollution, etc. Doesn't degrade the environment, and these are renewable. So you don't have to use fossil fuel because the supply of fossil fuel is limited. Oil, coal, etc. limited. So this kind of energy can go on producing year after year. You don't have to bother about supply of oil or fuel to burn and then generate energy. So government is actually emphasizing all over the world. The governments are emphasizing production of solar energy or wind energy like that. Now to encourage people to set up solar energy plants, okay, or wind farms, the government may provide certain grants. So if they may say, if you set up an solar power plant of this much of capacity, we'll pay you this much. This is meaning of grant. So normally it is given by the government. Sometimes for development of a backward area, government may say, if you set up industry in that area, in that locality or in that particular area, then we will provide you a certain sum of money as a grant. That is the meaning of grant. Is that clear, Subham? Since you asked the question, I thought, of course, we'll see an example of this while you progress. But I thought I just will make it clear what is the meaning of grant. Is it clear? Basically, one-time money, one-time payment normally made by the government to specific industries just to encourage them for locating their production capacity in a particular area or for setting up a particular type of plant or things like that. That is what is meaning of grant. So the definition will come to the definition of property, plant and equipment. First, we always start with the definition because that makes things clear. So Subham, I didn't get a response whether you have got your answer or not. Okay. So PP represents, PP represents tangible items. First of all, tangible items means basically food which has a physical existence, which can be seen, which can be touched, which can be felt. So PP represents always tangible items. Number one, they are used for production of supply, for use in production or for the supply of goods or services, or for rental or administration purposes. Rental if it is in the ordinary course of business. So the property, plant and equipment represents tangible items which are held for use in production or for the supply of goods or services or for rental or even for administration purposes. And they are expected to be used during more than one accounting period. That is the second category is very important. We use many things in production of or for supply of goods and services. Everything is not PPE because they are not expected to be used during more than one accounting period. So within 12 months they are going to be used up. So they are not PPE. So property, plant and equipment. Property, plant and equipment. I have told it earlier and you have missed it. First P stands for property, second P stands for plant and third and E stands for equipment. Is that clear? I have put it on the whiteboard. That's why you cannot see me, because I'm using the whiteboard frequently. So during the time I use the whiteboard, you won't be able to see me. Okay? So property, plant and equipment. That is the full form of PPE. Is that clear now? Okay. Now PPE represents tangible items. We otherwise call it fixed assets. There is another name for that. That is, in India we normally use this term fixed assets. They are one and the same. Fixed assets and property, plant and equipment are one and the same. Okay. So definition of PPE, basically they are held for use in production. A company or an entity holds those property, plant and equipment or fixed assets for use in production or for the supply of goods or services or for rental or for administrative purposes. And second thing is very, very important relating to PPE. That is, this kind of assets are expected to be used during more than one accounting period. They are not the kind of tangible items which are going to be used up in less than 12 months time. One accounting period normally 12 months period. So they are expected to be used during more than one accounting period. That is the second criteria, is very, very important. So the following figure represents the PPE. Number 1, held for more than 1 year. That is more than one accounting period. Number 2, used in production or supply of goods and services or for rental, earning rental or for administrative purposes. And third thing is they must be tangible. That means physical assets. So these are the three criteria, three important things relating to PPE. So for the item to come with the definition of PPE, all three conditions need be satisfied. If two conditions are satisfied and the third is not satisfied, then it is not a PPE. So number 1 condition is held for more than 1 year. If it is held for less than 1 year, it is called current asset. No more fixed asset. Something which is held for some tangible item which is held for less than 1 year, that is current asset. That is not a fixed asset, not property, plant and equipment. So held for more than 1 year this condition must be met. Secondly, used in production, supply, rental in normal course of business. That means the business is one of renting out properties. So in the normal course of business and administrative purposes. If not held for any of these purposes, like for used in production or being used in for supply of goods or services, or not for being used as rental in normal course of business, or not for administrative purposes, if these purposes are not met regarding use of the asset, it could be investment property. Supposing a manufacturing business owns a property, their main business is manufacturing, but they somehow have a property which they are at the same time renting out. That will be treated as investment property, not property, plant and equipment. If a company engages in the manufacturing of certain goods, they are having a property which they are not using for manufacturing those goods, or not for administrative purposes, not for housing their administrative office, etc. They are just simply renting it out to third parties. Then it will be an investment property, and the relative standard applied, accounting standard that will apply on that particular asset will be IS 40. Okay. So used in production, supply, rental in normal course of business or administrative purposes. If not held for this purposes, it could be investment property or non-current assets held for sale or for a discontinued operation, which is covered under IFRS 5. So different accounting standard will apply there. Third thing, it should be tangible. If it is intangible, that means it has no physical existence, but it satisfies the other two conditions, then it will be treated as an intangible asset which will be covered under IS 38, which we will be discussing subsequently. Okay, so these three conditions, each of these three conditions must be met so that one can call or recognize a particular asset as a fixed asset or PPE. various examples of fixed assets on your screen now. It will be coming on your screen. Premises. Furniture and fittings. Land and building. Office equipments. Plant and machinery. Even vehicles. Companies which are a transport company. So they own a number of vehicles. They are using the vehicles to provide transport services. So for them those are fixed assets. Computer hardware. These are all examples of different kinds of fixed assets, and remember this is only a illustrative. This is only the examples are just two examples. There could be many more examples like that. So this is not exhaustive list of fixed assets. This is not exhaustive list of fixed assets. This is only suggestive examples and not an exhaustive list for PPE. There are broad categories. In fact, PE gets classified under broad categories. Like one category can be land and building, the other category can be furniture and fixture. One more category could be computer and hardware, vehicles. Like these are basically there are broader categories within which different fixed assets gets classified. Now we'll talk about expenditure. What is capital expenditure? What is revenue expenditure? And what is deferred revenue expenditure? So capital expenditure is an expenditure that brings a new asset into existence or increases the operational or earning capacity of an existing asset. So by incurring this expenditure, the entity brings a new asset into existence. Entity buys a plant. Buys plant and machinery from a supplier. So the asset has been brought into existence. The asset was not there in the books of the entity. Or it can increase the operational or earning capacity of the existing asset. So by incurring that expenditure, the operational or earning capacity of the asset can be increased. So it brings an advantage or benefit of an enduring nature. So by incurring capital expenditure, a advantage or benefit of enduring nature is created, like additional floor constructed on administrative premises. So if the company constructs another floor on the administrative premises, that will help the company to provide more space for its administrative purposes. So that will basically the operational capacity may get increased due to that. Or even earning capacity of the entity may get increased due to this addition. Addition of space, addition of one more floor in the administrative premises. Revenue expenditure is an expenditure that brings an advantage or a benefit which will expire in not more than 1 year. That is the difference between a capital expenditure and revenue expenditure. Revenue expenditure will bring an advantage or a benefit, but it will expire in not more than 1 year. The advantage or benefit will not be available after more than 12 months. It will be available only in the next 12 months of incurring the expenditure. That is the meaning of revenue expenditure. Whereas the advantage or benefit that is available through a capital expenditure will be of an enduring nature. It will benefit the company or give the advantage over a period of more than 12 months. Here it will be only for 1 year. So expenses for day-to-day operations of a business, that is revenue expenditure, like repairs and maintenance in administrative premises. So construction of an additional floor in the administrative premises is a capital expenditure, but day-to-day repairs and maintenance of the administrative premises will be a revenue expenditure, because here the benefits will not last more than 1 year. This will be basically all profit and loss expenses are basically revenue expenses. Whatever expenses are basically shown in the profit and loss account whatever expenses are expensed to the profit and loss account, they are all revenue expenses. And last is deferred revenue expenditure. Deferred revenue expenditure is expenditure, it is not a capital expenditure. Although it appears to be the nature of capital expenditure because the benefit or advantage will be of enduring nature. Enduring means which lasts for a longer period of time. Enduring nature means which exists for a longer period of time. That is more than 12 months. So when you buy a plant or machinery, the benefit of that plant and machinery the company will be using that plant and machinery for next 10 years. So the benefit will be of an enduring nature. Benefit or the advantage of buying that plant and machinery will be of an enduring nature, which lasts for a longer period of time. Replacement of broken windows will be a revenue expenditure. Repairs, maintenance, these are all revenue expenditure. Okay. So deferred revenue expenditure, although they appear in the nature of capital expenditure because the benefit from the deferred revenue expenditure can also be obtained over a period of more than 12 months. So appears to be in the nature of capital expenditure, they are not capital expenditure for the reason the benefit will come in 3 to 5 subsequent years, and this will be written off. Like heavy advertisement, these are basically revenue expenditure, but here the benefits will be obtained over a period of time. Like a company goes for heavy advertisements. Now the benefit of that heavy advertisement, for which they pay huge sum of money, they go for heavy, like Reliance Jio. Let's say Reliance Jio is now making so much of advertisements. When it introduced the product in the market, even before the product was introduced to the market, they came up with a heavy advertisement, and now also they are continuing with heavy advertisements as their plans have been changed from, they have changed certain things like introduce the Prime membership, etc. All these things have been done, and these are they informing the potential target customers through advertisements, TV, etc. Now they are incurring a huge expenditure for that, but the benefit of that will not come over 1 year. Don't expect that the benefit of everything that they are spending today, this will basically to increase the revenue. Purpose of this expenditure is basically so that they can earn more revenue in future. But that will come over a period of time. That will not come in 1 year. So the benefit or advantage from the heavy advertisement expenses which Reliance Jio is incurring now will be obtained through increased revenue over next 4 or 5 years. So this kind of expenditure, we cannot expense it to the profit and loss account in 1 year because the benefit of such a revenue expenditure will be available for next 3 to 5 years. So what happens is that this kind of expenditure will be treated as a deferred revenue expenditure, and every year a part of that advertisement expense, if it is expected to give a 5-year benefit, then maybe 20% or so of this total advertising expenses will be expensed every year as a revenue expenditure. So that over a period of 5 years, the entire deferred revenue expenditure will get accounted for and written off. So that is what Reliance Jio, whatever advertisement expenses they are incurring today in their books, they will treat most of it, a part of it they will expense to the profit and loss account this year as revenue expenditure, and the remaining part will be held in the balance sheet as a deferred revenue expenditure. It's a basically asset, and that asset every year will be writing off a part of that deferred revenue expenditure as the revenue expenditure of that year. So that way, over a period of 3 or 4 or 5 years, they will write off the entire deferred revenue expenditure. So deferred revenue expenditure is a revenue expenditure. It is actually not in the, it doesn't create any, what we say, neither it creates any fixed assets, nor it creates any intangible assets, so to say. Okay, so it doesn't get involve creation of fixed assets or intangibles. Basically, it is for increasing the entity's revenue. Purpose is basically very simple to help in the company earning more revenues. Okay, and so, but since it is a kind of a thing, the advantage will be available over heavy advertisement will give you advantage over a period of 3-4 years. So it will be expensed over the 3-4 years as a revenue expenditure. So that portion which cannot be expensed this year will be, that remaining portion will be treated as a deferred revenue expenditure. Insurance is normally a revenue expenditure. Insurance premium paid for year to year. When you pay for the insurance premium, you pay annual premium normally. Unless you pay insurance premium, you take an insurance policy for 5 years and pay the entire premium at the time of taking the policy. The entire premium for 5 years, if you are paying at the time of taking the policy, then the 1 year premium, first year's premium will be treated as a revenue expenditure, the remaining will be deferred revenue expenditure. Unless you are buying an insurance which is where you are required to pay the entire premium upfront for a period of, let's say, 5 years. You are buying a buying an insurance policy which is valid for 5 years, and you have to pay the entire premium upfront. Then the first year premium will be expensed as a revenue expenditure, and the remaining 4 years premium will be treated as deferred revenue expenditure. Okay, we'll have more discussion on the revenue expenditure. Revenue expenditure is something which benefit is available only in the current year. That is the main thing. Revenue expenditure is the one thing whose benefit is available only in the current year. So we'll have a short break at this point of time and we'll continue on this. Okay? come back after the break. So, if you look at an expenditure, question is when a company incurs an expenditure, that is definitely for purpose of the expenditure is to get some benefit, economic benefit, in form of revenue earning. Now question is, the expenditure you are incurring, whether it will give revenue, it will increase your revenue, or it will provide revenue, or which period of time you are expecting that it will help you in generating revenue. Let's say when you pay salary to your employees, you are paying salary for the month of October to the employees. For the month of October, whatever they have worked, you are paying the salary. Don't expect that because you have paid the salary for October and don't pay the salary for November, they will work for the November. So the benefit you get from people working for you, it will be for only 1 month. 1 month salary will give you benefit from their working only for a 1 month period. Nothing more than that. So some expenditure are incurred where the advantage or benefit from the expenditure will last for a limited period of time. That is, if it is last for a limited period of time, less than 1 year, we call it a revenue expenditure. Some expenditure, a company is buying a buying plant and machinery. Now the benefit of that use of the plant and machinery, with the help of the plant and machinery, the company will be able to produce goods for next 10 years, and the goods can be sold. So the benefit will come over a period of 10 years. The expenditure incurred for buying the plant and machinery, that is a one-time expenditure, but the benefit will arise over next 10 years. So that is a capital expenditure. Is that clear now? The difference between revenue expenditure and the capital expenditure first. Then we will come to deferred revenue expenditure. So revenue expenditure is a kind of an expenditure where the benefit or advantage of that expenditure will last not more than 1 year. Capital expenditure is expenditure where the benefit or advantage that will arise from that expenditure will last more than 1 year. It is of enduring nature. Longer period it will give you benefits. That is capital expenditure. Now there are certain expenditures which appear to be in the nature of capital expenditure, but they are really revenue expenditure. Like I gave you the example of advertisement. Like Reliance Jio, since last 6 months they are putting up advertisements in any popular TV channel you see, newspapers you see, they are coming up with advertisements first with at the time they launch their product, and subsequently their Prime membership, various plans, etc. They are putting up expenditure, continue hoenga, all these kind of things, and they are incurring huge expenses for that. What is the purpose of this? Normally advertisement is for generating more revenue, because when you advertise, people will buy, you expect people will buy your products. They will be seeing the advertisement, they will be induced to buy your product, and it will generate more revenue. Okay. But when this kind of advertisement expenditure, a company which has come to the market for the first time with their products, they are incurring heavy expenditure. They are doing it because they are expecting that this expenditure will give them a new membership. Lot of people, not subscribers will be there. Their subscriber base will go up, and the subscribers will be using their various plans over next 3-4 years, and that's how the revenue will grow. So this is the nature of the deferred revenue expenditure. Here the benefit will come over a period of time. So deferred revenue expenditure and capital expenditure are similar in nature, because here in both cases the advantage or benefit from that expenditure will be over a period of time, more than 1 year. But this is not treated as a capital expenditure because it doesn't create any fixed assets or anything. Just by giving advertisements, you are not creating any fixed or intangible asset. Okay. So deferred revenue expenditure is basically the expenditure which is incurred but whose benefit will last for more than one period, accounting period. Like somebody just now asked the question, insurance premium. Now normally insurance premium, if you are paying for taking a policy, that part of the premium which is applies to that particular accounting period will be treated as a revenue expenditure. But if there is a part of the premium which applies to the next accounting period, we treat it as a deferred or prepaid expense. That is also deferred revenue expenditure. Is that clear? So you have to look at the nature of the expenditure, what benefits it will give, and how long the benefits will be available. Then decide what is your OPEX, operating or revenue expenditure, which is CAPEX, and which is deferred revenue expenditure. So we will now talk about the scope of IAS. Coming back to, I am responding to a question from Bandana from Durgapur. She wants to know my name. My name is Anup Ray. So IAS 16, let's look at what IAS 16 covers. Of course, we will be going into more details. So IAS 16, which we are discussing today, International Accounting Standard 16, relating to property, plant and equipment. It deals with the recognition. When do you recognize an asset as a property, plant and equipment under that category? So recognition based on future economic benefits. There must be a future economic benefit arising from that asset, and that can be measured reliably. Then how measurement, when you recognize in your books of accounts a item of property, plant and equipment, how it is measured, what value you put in the books of accounts. So measurement at recognition will be purchase price plus taxes plus duties. It can include dismantling cost. It can include also other directly attributable costs. We will discuss all these things one by one. Then IAS 16 PP also, relating to PP, also deals with measurement after recognition. You recognize the PP, initial measurement you make. What about subsequent measurement? So after 1 year, how much will be shown in the books of accounts as the value of that particular item of property, plant and equipment. So measurement after recognition, there are two models we talk about. One is the cost model, the other is the revaluation model. That also we'll discuss in details. Then we'll talk about depreciation of property, plant and equipment, how it is recognized in profit and loss statement, normally with a systematic basis over the useful life of the assets, and which causes a reduction in value of the assets. And last thing we'll talk about the derecognition. At what point of time will we recognize the property, plant and equipment, a particular item? When you derecognize, it can happen on disposal of that item when you sell it, or when no expected benefits is available from its use. Which gap? Again, this doesn't, I cannot understand what you mean by this figure. It's available in your e-book. Yes, you don't have to write it down. This diagram will be available in your e-book. Right? That is responding to the question of, yes, this responding to your question, I understand now. Yes, the present display should be available in your e-book. So you don't have to draw it. Anyway, yeah, basically, whatever covers under IAS 16 is going to be discussed in details from now on. So these are the things which we are going to discuss. So first we come to recognition. So the first thing we are discussing is recognition. Okay? So recognition. When a PP is recognized, when are we going to recognize a property, plant and equipment? two conditions must be met. Number one, future economic benefits are probable. That means from this particular asset, the entity will be deriving some future economic benefits. That is probable that the entity will derive certain future economic benefits. Second thing, the cost of the asset can be reliably measured. Two things are very important for recognition. Number one, you expect some future economic benefits from the use of the asset. Number two, its cost can be reliably measured. If these two conditions are met, then a particular asset can be recognized as a property, plant and equipment in the books of accounts. But both the conditions must be met. You have some asset whose cost cannot be reliably measured, you cannot recognize it. You have an asset whose cost is reliably measured, but you are not, there is no probability that he will be deriving any future economic benefit from the asset. So if any of these conditions are not met, then recognition cannot be made. So recognition criteria is basically future economic benefits are probable and a cost can be reliably measured. So if an asset doesn't provide future economic benefits, then although it meets the definition of PPE which we discussed earlier, it cannot be recognized in the books. If there is an asset which meets the normal criteria of PPE, with the definition of PPE, that there may not be any future economic benefits from the use of the asset, it cannot be recognized in the books. So both these are essential conditions for recognition of the PPE in the books. If on the other hand, if cost cannot be reliably measured, it again cannot be recognized. Like example is, of course, it is not a PPE that doesn't come under definition of PPE. Goodwill of a business. Self-generated goodwill. Self-generated goodwill of a business. Can it be recognized as an asset in the books? No. Simply because the cost cannot be reliably measured. So for recognition of anything in the books, the most important thing, recognition of any asset in the books, the cost should be reliably measured. Only if this condition is met, then it can be recognized. The other condition is that it is probable that future economic benefits will be derived from the asset. So recognition criteria are always essential for capitalization, whether initial or at a subsequent year. If the recognition criteria is not met, both this recognition criteria is not met, then you cannot capitalize the asset. Capitalize means basically recognize it as a capital asset in your books. Now what is cost of acquisition? Initial measurement of, now we come to the measurement. Now initial measurement of a fixed assets in the book, when you are going to recognize it, at what cost you will recognize it, that is called initial measurement. So initial measurement is the cost of acquisition or construction. So it can be the purchase price, the amount paid, or fair value of other consideration given to acquire or construct the asset. So the purchase price, you have to, if it is an imported item, then you have to add the import duties. Non-refundable purchase taxes like VAT, etc., that can be added. If there are discounts and rebates given by the supplier, that can be reduced from the purchase price. If any discounts or rebates have been given by the supplier. Borrowing cost for qualifying assets can be added. This qualifying asset we will discuss afterwards. But if there is a borrowing cost involved, it means funds have been borrowed to purchase the asset, then interest on that borrowing, that is called borrowing cost. So borrowing cost can be only added if the asset is a qualifying asset. What is a qualifying asset we will discuss, we will explain afterwards. This is under IS 23. Borrowing cost for qualifying asset can be added. Any cost which is directly attributable to the acquisition of the asset can be added. And lastly, when the asset is purchased or asset is brought into existence, If there is a condition that the asset after a certain period of time, supposing some company is setting up a plant for manufacture of certain products. Now from environmental condition, there is a environmental consideration, there is a condition that after 10 years or 15 years, the plant must be dismantled and plant cannot be used for more than 15 years. It must be dismantled at the end of that period, and the site must be restored to the original condition. If there is a condition like that, then the initial estimate of any unavoidable dismantling and restoration cost must also be added to the for the purpose of initial measurement. So first of all, we have to basically, what are the components, various components of the cost of acquisition or construction? This is given here. One could be the purchase price, import duties, non-refundable purchase taxes like VAT, less discounts and rebates if any given by the supplier or the seller, borrowing costs only for qualifying assets, directly attributable costs, and if there is unavoidable dismantling and restoration in future which has to be done, then initial estimate of such unavoidable dismantling and restoration cost also must be added. See, dismantling cost I am just trying to explain to you. Sometimes for certain kinds of industries, from environmental consideration, the government may allow the industry to be set up or the plant to be set up under a certain condition. The condition could be that after certain years of use, the plant should be removed from that site. That means the plant should be dismantled from that particular site, and the site should be returned to the original condition, that is restored to the original condition by the company which set up the plant. So it is this is a condition imposed at the time the government allows the plant to be set up. So you have to take the estimate of how much it will cost to dismantle the plant and restore the site. That has to be taken, and that amount has to be also added as for the initial measurement of that asset. So the factory may have to be removed. The place where the factory was located must be returned to the original condition, that is the condition before the factory was set up. So if this kind of conditions are applying for setting up a factory, then for initial measurement of the cost of the factory, this cost must also be included. Estimate of this cost must be included as for initial measurement purpose. So cost directly attributable. Some of the examples of cost. Some of the examples of directly attributable cost. Yes, restoration cost, as I told you, supposing a factory is being set up in a ecologically sensitive location. The government allowing a factory to be set up in a ecologically very sensitive location. Okay, and government is giving a condition that the factory can be operated for next 15 years. At the end of 15 years, the factory owner must remove the factory from that site. That means they must dismantle the plant and machinery and restore the site to the original condition. That means the site should be brought back to the original condition which was existing before the factory was set up. That is called restoration cost. If that is the condition, it doesn't apply to all industries, it doesn't apply to all factories, but it may apply to certain factories, certain cases. If it applies, then this is a part of your cost, because you have to ultimately incur that cost. So that cost should be taken into account while making initial measurement of the factory or the plant and machinery. So you can only get an estimate. At this moment of time, you are not incurring the cost. The cost will be incurred after 15 years. So you can try to estimate what will be the cost of dismantling the factory after 15 years and restoring the site to the original condition. So that estimate of the cost that may be incurred after 15 years should be added or should be included in the initial measurement of the cost of the factory. That is the point I am making. Is that clear? I am responding to Hemant's question. We'll see an example which includes that installation cost. We'll see an example subsequently. So examples of directly attributable cost. We talked about directly attributable cost. Add directly attributable cost. In the slide, among the various components which have to be included for initial measurement, there is one called directly attributable cost. So some examples of directly attributable cost I am now providing. Cost of employee benefits. So the employees who are engaged when for construction of a building or construction of the plant and machinery, etc., who are engaged in when the plant and machinery are being installed, etc., that cost of employee benefits. Cost of site preparation. Initial delivery, transit insurance and handling cost. Installation and assembly cost. Even cost of testing before the factory is or the machinery is put to use, it is tested. So cost of testing. Professional fees. You have to pay professional fees to the architecture, you have to pay professional fees to the lawyer, etc. involved in the acquisition process. So these are all directly attributable costs. So the test, whether a cost is directly attributable or not, the best test is if that cost is not incurred, if that cost are not incurred, whether the acquisition would have been possible or not. The cost which is directly attributable is the cost which, without incurring which the acquisition of that plant and machinery or that particular property, item of property, plant and equipment would not have been possible. That is the test. So cost directly related to getting the asset ready for the use. These are called directly attributable cost. So employee benefits of those involved in the construction or acquisition of the asset, like salary, wages, benefits, contribution to provident funds, etc. These are in the employee benefits which are directly attributable to the acquisition of the asset. Cost of site preparation, like getting a site ready for installation, like cost of leveling the factory floor before the new machinery is installed. Before the new machinery is installed, you have to level the factory floor, or you have to prepare the factory floor. You may have to make it concrete. So basically the cost of site preparation. Factory floor has to be leveled, then concretized, and all these things have to be done. Then initial delivery, like shipping, carriage, etc. The plant and machinery may have to be shipped from USA to India. The shipping cost, carriage cost. Then transit insurance. During the shipping transit, it has to be insured. Supposing some plant and machinery are imported from Germany, it has to come by sea. So during the sea voyage, it has to be insured, because otherwise, if the ship sinks, that machinery sinks, then the entire money will be lost. It has to be insured by transit insurance, the cost of that insurance. Loading, unloading. At the port, there will be unloading charges. At the factory, and again it has to be loaded into some other transport, and again brought to the site of the factory, unloaded. So this loading, unloading charges. Installation cost. So when you bring the various parts of the plant and machinery, they have to be installed, they have to be assembled and all that. So cost will be incurred for that. Cost of testing the asset. Like a new aeroplane, when it is purchased, it is not, a new aeroplane purchased by a airlines company will not be put into operation immediately. It will be tested for some days. So there will be test flights carried out with the new aeroplane, and once they are sure that the aeroplane is functioning properly, then only it will be put for commercial use. Cost of testing. So safety test flights will be conducted for a new aeroplane, and once it passes the test, then only it will be put to use. That is testing cost. Borrowing cost could also be included, provided borrowing cost is basically interest and other financing cost on loan taken for purchase of that particular property, plant and equipment item, but it must be a qualifying asset. So what is a qualifying asset? We will discuss it afterwards. Then professional fees, like you have to pay fees to the architects, the architect who will draw the plans for setting up the building the factory premises and all that, surveyors, some legal costs may be involved, all this. These are professional fees. So all these are directly attributable cost. The test is basically whether a cost is a directly attributable cost or not. You can understand only considering whether without incurring that cost, whether the acquisition could have been possible. If without incurring a cost, particular cost, the acquisition could have been possible, it is not directly attributable. But if without incurring that cost, we could not have acquired or constructed the asset, then it has to be treated as a directly attributable cost. Examples I am giving also of costs which are not directly attributable, so it will not be added in the initial measurement of that asset. So examples of cost not directly attributable and hence not capitalized, so those costs will be expensed to the profit and loss account. Since these are not capitalized, these are not added to the initial measurement of that item of property, plant and equipment, so they will be shown as operating expenditure and expense to the profit and loss account. Like cost of opening a new facility, that preoperative expenses. Before a new facility is opened, some expenses are incurred. These are called preoperative expenses. That is not a directly attributable cost. Cost of introducing a new product or service. That is not a directly attributable cost. Advertising and promotional cost. These are not directly attributable costs. This cannot be capitalized. Cost of conducting a business in a new location or with a new class of customer. Again, it is not a directly attributable cost. Okay, I will just stop here because Praveen Kumar from Delhi cannot place once the previous slide. I will go back to the previous slide and then come back again to this slide. Okay. So, Praveen, tell me once you are finished. Once you are done with this slide, I am giving you the idea slide. It will come on your screen. Now it is available on your screen. So once you are done with this slide, let me know because then I can move to the next slide. Thank you. So we go back. Now we go to some examples of costs which are not directly attributable and hence cannot be capitalized. They have to be expensed to the profit and loss account. So I was telling you, describing you these examples, like cost of opening a new facility, preoperative expenses incurred before opening of the new facility. That is not a directly attributable cost. Say a new branch is open, new sales office is open. So the expenses are incurred before opening the new sales office. That is not a directly attributable cost. Cost of introducing a new product or service. That is not a directly attributable cost. Advertising cost and promotional cost. These are not directly attributable costs. This cannot be capitalized. Cost of conducting a business in a new location or with a new class of customers. Again, not a directly attributable cost. Training cost, training of the employees. Not a directly attributable cost. Administration and other general overheads. They cannot be directly attributable cost. Initial operating losses. The losses which are incurred initially for the first maybe 1 year or 2 years. These are called initial operating losses. They cannot be directly attributable. And cost of relocating or reorganizing part or all of an entity's operations. Cost incurred in relocating or reorganizing part or all of the entity's operation is also not a directly attributable cost. The best way to understand if cost is directly attributable or not, how how to understand whether a cost is directly attributable or not is to test whether the asset could have come into existence and being put into use without the given cost being incurred. If the asset could have come into existence and put into use without incurring that particular cost, that is not a directly attributable cost. But if the asset could not have come into existence and could not have been put into use without incurring a particular item of cost, then it's a directly attributable cost. So test is, if you look at an item of cost, we have to test whether without incurring that cost, could we have brought the asset into existence or could we have put the asset into use. If the answer is no, it is a directly attributable cost. If the answer is yes, it's not directly attributable. That is the test. So we look at a small quiz regarding capitalization. Capitalization basically means adding that cost to the initial measurement of the cost of the property, plant and equipment item. That is capitalization. Which one of the following expenditures can be accounted as a capital expenditure? Like cost of painting a building, replacement of windows in a building, purchase of a car by a garage for resale, and legal fees incurred on the purchase of a building. So only legal fees incurred on the purchase of a building is a directly attributable cost, because without incurring the legal fees, it would not have been possible to purchase the building. Rest of the things like cost of painting of a building is not a expenditure of capital nature. Neither replacement of windows in a building is expenditure of capital nature, nor purchase of a car by a garage for resale is in the nature of a capital expenditure. So only the fourth item is a expenditure of the capital nature. That's capex. Now we look at a particular case study on capitalization. AB PLC purchased a new plant at its production facility. The following costs have been incurred. Cost of the plant as per the supplier's invoice plus taxes, 2.5 million. Initial delivery and handling cost, 200,000. Cost of site preparation, 600,000. Consultants used for an advice on the acquisition of the plant, 700,000. Interest charges paid to supplier of the plant for a deferred credit, 200,000. Estimated dismantling cost to be incurred after 7 years. The plant has to be dismantled after 7 years. The estimated dismantling cost to be incurred after 7 years is 300,000. And operating losses before commercial production, 400,000. Now tell me which are the costs that can be capitalized in accordance with the IAS 16. Which are the costs which can be capitalized as per the IAS 16 and which cannot be capitalized? That is what I would like to know. So advise PLC on the costs that can be capitalized in accordance with the IAS 16 and which cannot be. So here, cost of plant, yes, it can be capitalized. Initial delivery and handling cost, yes, it can be capitalized. Cost of site preparation, yes, it can be capitalized. Even cost of the fees paid to the consultant for advice on the acquisition of the plant, yes, it can be capitalized. But interest charges paid to the supplier on the plant for a deferred credit, which is a borrowing cost, that cannot be capitalized because it is not a qualifying asset. Now I will explain what is qualifying asset. This not being a qualifying asset, the interest charges paid to the supplier of the plant for the deferred credit, because you are going to pay him over a period of time. You are not paying the entire money. ABPLC is going to pay the supplier over a period of time, so the supplier will be charging some interest. That is a borrowing cost. But since this is not a qualifying asset, the interest charges paid to the supplier of the plant for the deferred credit will not be capitalized, cannot be capitalized. borrowing cost can be capitalized only if the asset is a qualifying asset. And we'll explain what is qualifying asset. Estimated dismantling cost to be incurred after 7 years, yes, it has to be capitalized. It's an estimate of the dismantling cost. The factory or the plant has to be dismantled after 7 years. So the cost of dismantling the plant is estimated to be 300,000. That has to be capitalized. Operating losses before commercial production cannot be capitalized. Okay, so except for the two items which are basically cost of interest charges, borrowing cost, interest charges paid to the supplier of the plant for the deferred credit, and the operating losses before commercial production, they cannot be capitalized. Now borrowing cost. Coming back to the borrowing cost, because I told you we'll be discussing these two accounting standards, IAS 23 on borrowing cost and IAS 20 on government grant normally. That will be discussing when the context comes. So the context has now come. The borrowing cost should be capitalized on the following conditions. If the following conditions are met, then only borrowing cost can be capitalized. Number one, most important, the asset is a qualifying asset. Qualifying asset is an asset that normally takes a substantial period of time to get ready for its intended use or sale, like heavy plant and machinery, building, etc. Now, building cannot be built, takes a long time to build, to construct a building. A heavy plant and machinery cannot be built in a quick time. Okay. Ship, if you are acquiring a new ship takes maybe around 12 months or more to build. Okay. So this kind of heavy plant and machinery or building, etc., which takes a substantial period of time to get ready for the intended use or sale, these are called qualifying assets. Borrowing costs basically include interest on loan and other costs incurred by an entity in relation to borrowing of funds for the acquisition of the asset. So interest and other costs means finance charges, discount on borrowing, loan processing fees, everything. These are borrowing costs. So borrowing cost should be directly attributable to the acquisition, construction, or production of the asset. So the borrowing cost, that means the interest or loan processing fee, relate to money borrowed for acquisition, construction, or production of the asset. Number 3 condition is cost can be reliably measured. So the borrowing cost should be, it is possible to measure the borrowing cost reliably. Capitalization will start, from when the capitalization will start? Only when the activity is necessary to prepare the asset for its intended use has begun. And capitalization will be done, that means interest charges incurred will be capitalized till the asset is available for use. So the interest paid to the bank from the time the asset is, activities have been started to prepare the asset for its intended use, and it will continue till the asset is available for use. So all interest incurred during this period, all borrowing costs incurred during this period, directly attributable to the acquisition, construction, or production of the asset, can be capitalized provided the asset is a qualifying asset. So this is the condition of IAS 23. So in the earlier case, the asset which he considered was not such a type of asset, it was not a qualifying asset. Now we'll come to also IAS 20. Government grants. Somebody is asking what is grant. Government grants related to depreciable assets are usually recognized as income. The grants are recognized as income. They are not capitalized. So the government grants related to depreciable assets are usually recognized as income over the periods and in the proportion in which the depreciation on the assets is charged. So let's look at an example to understand this. Now grants, we are not going to discuss IAS 20, so we will just look at the particular example just to understand the point on government grants. ABC Corporation received a grant of 150 million from the government to install and run a solar power generation system in an economically backward area. So the government is actually giving this grant to encourage industries to install and run solar power generation system in the backward area because that will generate employment in the area. Government gives this kind of grant basically to generate employment in the backward area, with the generation of employment in the backward area, because if such a huge plant is set up there, it will create a lot of employments and the economically backward area can possibly develop faster. That is the idea. So ABC Corp received a grant of 150 million to install and run a solar power generation system in an economically backward area. ABC Corporation has estimated that a solar system will cost 250 million to construct. The solar system is to be depreciated using the straight line method over a period of 10 years. What will be the treatment of the grant? So how the 150 million will be treated in the books of accounts of ABC Limited? So, sorry. Now since the depreciation is going to take place for depreciable assets, the rule is, IRS 16 says, the government grant should be recognized as income over the periods and in the proportion in which depreciation on the asset is charged. Now depreciation of the asset will be charged over 10 years, each year at the same rate of 25 million. So the government grant of 150 million will be treated as an income in the books of ABC Limited every year. 15 million, 1/10 of that will be treated as an income in the books of ABC Limited for next 10 years. 150 million is the government grant received, and out of that, 15 million each year will be treated as an income in the books of ABC Limited for this treatment. I hope this is clear to you. So income over, it will be treated as a income or recognized as income over the periods and in the proportion in which depreciation on those assets is charged. So the asset is a depreciable asset. It is going to be depreciated on straight line method over 10 years. So every year 25 million or 10% will be depreciated. So 10% of the government grant also will be treated as, 150 million will be treated as an income for each of these years. So I hope this is clear to you. Now I will request you to give your feedbacks because we are approaching the closing time on the session. So please submit your feedbacks. Just a minute. Bandana, some of you I find is saying that you are giving the feedback that you are not understood the concept or you have problem with the pace. So why don't you say something during the class? Why are you silent when the class goes on? You are not asking any question. None of you have asked any question during the class. This is not done. This is not acceptable. If you have any difficulty, you have to ask questions. You cannot keep silent and at the end you cannot say, I have not understood the concept or I am not satisfied with the pace or things like that. Okay, we are closing the session today.